Today is the 25th of May 2025, and this video will probably document my snapshot reflection of the financial markets. And I believe there is this very apt saying, there are weeks where it felt like decades, and there are decades that felt like weeks. And of course, with our commander in market manipulation, commander-in-chief in the White House today, folks in the finance industry are constantly in this state of flux because we are always one headline away to market volatility. So on this personal channel of mine, I've refrained from commenting too much around this issue, around the Trump tariff, the trade war, etc., mainly for two reasons. I think firstly, because it's dynamic, it's ongoing, it's ever-changing. Even if I put out content, maybe the next day it's deemed irrelevant or not useful anymore. So information gets outdated very quickly. And secondly, I think for myself, I tend to ask myself what the audience can take away from a particular message or a particular piece of content. So on that note, I think as an armchair analyst, around this whole tariff issue, I don't think I have much to offer. But don't be mistaken, I think not sharing my opinion or view in a timely fashion through this sort of video content does not mean that I don't have an opinion of how things are moving. In fact, I think this whole deal around Trump's tariff is probably one of the most, if not the most critical issue people in finance actually talks about, especially with all these sophisticated models and reasoning and analysis with the second, third, or 69th order impact of how one thing lead to another. But that's besides the point. Especially through many of these so-called closed-door discussions and exchanging of opinions of people live and breathing finance. After coming out of many of such discussions, I always tend to ask myself the same question. How does it actually affect me, and by extension, my portfolio? And is there any specific course of action that I should take to protect myself or to better profit from this scenario? But even with the benefit of hindsight today, I'm not too sure if I have a convincing enough answer to that question. So I'll use this video to basically package all my thoughts and opinions and reflections throughout this period. And I hope that at the end of this video, you can at least take away a thing or two. Now, to basically paint the context, I think to look at the benchmark index, of course the S&P 500, looking at the SPX, at its peak, it was trading at roughly 6,100 points. And to the recent trough, it was roughly around 4,800. So that was a delta of roughly 21%. But the S&P 500 actually did not close into a bear market because the 4,800 was an intraday low. And today, we are sitting at roughly 5,800 points. And this is roughly the same level around the mid-October 2024 and at the start of 2025. So there were many high-intensity moments for sure, and I probably want to jog your memory a little. And like GPT, I can give you a 5-point summary. I think firstly, the whole tension escalation started from the Liberation Day announcement, and it basically wiped out $6.6 trillion worth of market cap in 2 days. And of course, the insane tariff war escalation with China that went up to the highs of 145% tariffs. Thirdly, you have the Q1 GDP of the US that went negative, mainly due to the import of gold and also front-loading of certain imports to skirt away some of these tariff implementations. Fourthly, I think the main culprit for some of this correction was how everyone was scrambling to underwrite I can't say a new world order, but more so a new set of risks and assumptions for existing market models. And I think it's quite ironic or quite funny how a few years ago, people were saying that there were a lot of regulatory uncertainty around the Chinese markets. And I think the same can kind of be said for the US today. And of course, last but not least, the bond markets with yields being all over the place, and spending with the whole Department of Government Efficiency looking like a tough nut to crack. So to my Singapore residents, from now until the 31st of May 2025, you can actually sign up and make your first deposit with Tiger Brokers to unlock instant rewards and cash bonuses worth up to 1,000 Singapore dollars. So this is a quick plug for Tiger Brokers. At the very base tier, you can deposit a minimum sum of 3,000 Singapore dollars, maintain it for 60 days, and receive a $100 US stock commission card and $100 worth of cash vouchers. And if you're starting with a larger capital size, the reward tiers actually scale up too. It is also worth highlighting that Tiger has just launched a Cash Boost account, or CBA for short, and it's tailored for today's volatile markets. So if you sign up via the link below and open a CBA account, you'll enjoy 90 days commission-free trading and a $20,000 trading limit. So in a market where a single headline can move everything, having the right tools to act quickly can actually make a difference. But tools being tools, remember to use them smartly and also responsibly. If not, you can just stick to benefiting from the new user promotion. So link to everything will be in the description box down below. So with that in mind, let me share a little bit more of my thoughts around this whole Trump tariff investment style. So I believe that we are all in the front row seat witnessing how history is playing out. And you tend to always have two groups of investors or ideologies conflicting with one another. On one hand, you have the seemingly intelligent ones, coming up with complicated analysis, throwing out facts, numbers and figures, sounding pretty convincing of how GDP and unemployment is going to be affected, and so on and so forth. And sometimes you can then lead down to the conclusion that based on this set of analysis and assumptions, they recommend you to take certain positions or even to come up with different portfolio mix to better quote-unquote weather the storm ahead. But on the other hand, you have another group of people that feel like ostriches that are burying their head in the sand and they're refusing to budge from their existing positions. And on an anecdotal note, of course we have friends that are Tesla fanatics. So to the people that love Tesla at their all-time high of $488 per share, they continued buying their way down with no regards to the naysayers, calling out for a recession, of the China tariffs on their cars. But don't misunderstand the point that I'm trying to convey here. I'm not saying that the coast is already clear. In fact, I think a lot of people will argue that there will be 3 years of great volatility ahead, and I tend to probably agree with them. I'm also not saying that the bulls should declare victory so early on, because I really swear by this philosophy. I really don't think anyone has a high degree of confidence as to guess where the markets is going to turn up or end up in the short term, which is within the next 12 months or so. Everything is just guesstimates, and your guess is as good as mine. But I just found it quite amusing that when you talk to someone from a specific persona, I think you can probably guess with high confidence level of their existing positions. And I personally have a friend that turned really bearish after the Trump Liberation Day announcement. And he's still sitting on roughly 60 to 80% cash today after selling almost all of his existing equities. And to add on to the different personas, I do believe that you have people around you that played with this whole whipsaw volatility. I can't say for sure whether they made money or not unless they print their entire brokerage statement for your own viewing. But they were in the group of selling first, thinking about it later, and then subsequently buying back after the course seems to be quote-unquote a little bit more clear. And then of course you have that group that just closed their eyes and continue holding on to their position. And of course the last group that closed their eyes, hold on to their position, and still bought even more stocks amidst this volatility. And through this whole process, I've actually documented my own journey as well. I've actually posted a video saying that I was buying throughout the last 3 to 4 months. Maybe not as aggressively as some of you might hope for, but at least I'm still putting my money where my mouth is at. I would like to remind the bulls to not count your chickens before they hatch, especially coming from someone who have sat through 3 to 4 years worth of bear market since 2020. And if you start to be disillusioned, thinking that you know where the market or how the market is going to move in the near term, then I think you need to kind of revisit your set of assumptions. So they're uncertain, they're unpredictable. You don't just buy the dip and expect to win within a short feedback period. And you just have to brace yourself for the worst case scenario. So I think the main takeaway here is that we are just taking a snapshot of where we are at currently. And we really don't know who has the last laugh. But one thing for sure though, you only know your level of conviction when you sit through 30 to 50% drops. And as the saying goes, the strongest storms make the best sailors. So those that didn't really understand what they stood for, whether is it on an investment philosophy level or down to which stock they are buying, they started to switch things out here and there. And this group of people on the aggregate, in my personal opinion, actually suffered the most. And if we were to switch our discussion, to people that are a lot more sophisticated, they most likely did their own fair share of homework regarding this whole Trump tariff impacts. And most of them, based on my own experience, tend to have their own scenario analysis. They started planning out pretty extensively in terms of what are the different course of actions or action plans. They probably will have some sort of an impact report and probably probabilities assigned to different scenarios. And I tend to always cheekily ask them, actually, where do you get all these numbers from? Is there some sophisticated models? More often than not, the answer that I got back is that they just chuckle and say that they pulled it out from their ass. But I think that's not to denounce a lot of the work that is being done. And through many of these discussions, there are a few factors that I see constantly pop up. And I generally summarize their Trump playbook in three key factors. Firstly, you want to look at companies with a strong balance sheet that can weather any storm, regardless of what Trump is going to announce. Secondly, you want to focus on companies with strong pricing power to basically offset any of the cost effects that's going to arise, and more importantly, being able to pass down many of these so-called taxes that they're going to collect. And the third point, which is to overweight on companies that are in the defensive sector, in the essential services sector, like transport, utility, healthcare. Because regardless of how the economy is going to perform or what Trump is going to announce, people are still going to take public transport, they need to use energy, and if they have any illnesses, they have to consume the healthcare solutions. So I think everything sounds fine and dandy, pretty logical, until you take a closer look. Actually, if you were to ask yourself, shouldn't all these questions or factors already be part of your investment process, regardless of whether Trump announces tariffs or not, and whether tariffs are a good or bad thing net to these companies? So if you think about it, do you mean that you are telling me that before this Trump tariff, you don't buy companies with pricing power, you like companies that are price takers and have no influence over their revenue? And to drive home the point, before this whole Trump tariff, are you picking companies with a weaker balance sheet because you hope that they go bankrupt as soon as possible? I think that's pretty counterintuitive. But just a side note here, of course, there are investment styles that maybe focuses a lot more in terms of the speculative growth company types, where this group of companies tend to have weaker balance sheet naturally. But does this also mean that you're switching out your investment style to react to this macro event? And switching investment styles are completely different from just rule of thumbs or good matrix to follow. So I think that's important to distinguish. And on that same note, if you've initially had reservations against investing in such defensive utility-like companies because of slow growth, because of lower margins, so on and so forth, are you suddenly going to start buying more railroad and energy companies just because you want to react to this so-called macro event? So that's why I wanted to layer in this nuance to keep you abreast of what kind of decisions that you're making and to not get too caught up into thinking that, oh, this is the Trump playbook, that's why I should follow it to the T. And does it also mean that if Trump cancels everything tomorrow, you are going to adjust your investment style and philosophy once again? So net-net, if you were to think about many of these discussions, it doesn't feel like the analysis value added much. In fact, it might make some investors even more confused afterwards. And there was also this one point that was made recently, which is to look at companies that are so-called quote-unquote insulated from this global trade situation. You can think of companies like Tencent, which I personally own, that mainly operates in China. Their installed user base of over 1 billion users, mainly in China. Yes, they do have some sort of an international gaming exposure, but those are more services in nature. So if you look at a company like Tencent, you might seek some sort of comfort because they might not be impacted as disproportionately as compared to other companies that are at the heart of this whole geopolitical tension, like maybe Nvidia, for example. Or another company like Lockheed Martin, which is a US defense contractor. And you can bet your ass that they wouldn't be making any deals with their Chinese counterparts. So when looking at companies on this insulated level, on the initial level, it sounds like a pretty interesting and a pretty good insight. But here's the thing. I think no doubt that both Tencent and Lockheed Martin can and potentially would be good investments. But I don't think that you should buy them just because they're insulated. You want to buy them because they're great compounders, they're great businesses, and they compound shareholders' wealth. And not forgetting that by being insulated, that means that they are being cut off from the benefits of being able to scale and profit massively from other markets, which then also enables them to extend their growth runways or growth curves. And if you think about it, it's all a trade-off. So Tencent being a stronghold in China, their WeChat is unable to scale globally. Lockheed Martin, they are unable to get Chinese contracts from the Chinese government. So it kind of have some sort of a ceiling in terms of their expansion. And this is the trade-off you're talking about when you're looking at insulated companies. And also to add on to the point on pricing power, and you can draw certain examples of different companies with incredible pricing power. People that operates in the ultra high-end luxury space, like Hermes and even Ferrari. So Hermes makes luxury bags. They are probably selling their Birkins at like 20-25k per pop. And if they do get hit by many of these tariffs between the US and EU, and now they sell their Birkin bags for 35,000, 40,000 per bag, I think consumers will go even crazier due to the level of scarcity. And for Ferrari, it's quite intuitive. The signaling effect that man needs to impress other people, it's an innate human desire. So if a Ferrari starts to double in price the next day, I think consumers will be even happier. But that's besides the point, you see. Because due to the nature of this prestige, they can't increase their supply, which also means that intuitively they cannot be ultra high growth. And if barring any crazy circumstances, maybe from lockdowns or very low comparable sales, you don't expect Hermes or Ferrari to increase their earnings per share by 20 to 30% in any given year. So I do hope that you understand that everything is a trade-off. And by opening one loop, you'll need to answer even more questions down the line. And these things actually takes time to understand and appreciate. And the worst time to be doing this sort of thinking exercise is when your emotions are running all over the place, with your portfolio experiencing big red candles on a daily basis. So I think when focusing on companies on the watch list, this exercise of pruning your watch list should be done prior to any sort of volatility event, and not so much about trying to scramble to find the next best alternative to react to a specific macro event. Buy Hermes because you think that it's a great compounder. Buy Ferrari because you know that it's a good company, not because you want to combat or trying to insulate your portfolio due to the Trump tariff. So as we kind of tie up this entire discussion around how many people are talking about reacting to this whole Trump tariff event, I think I have a few last points that I wish to make. So markets have always been plagued with bad news. That's why we have the saying that the markets always climb on a wall of worry. And some of you would argue that it's going to get worse. And I personally probably will agree. But don't forget that in the world of finance, businesses especially, they are incredibly innovative and adaptable. And that's probably also one of the main reasons why we all put our money with them in the first place. We hope that they do a better job in terms of compounding our wealth and investing in lucrative opportunities. And just understand also that as the market is a pretty efficient kind of pricing mechanism. So whenever all these news headlines actually hit the market, a lot of all these market participants are reflecting their real-time view. And they kind of try to price in many of these assumptions. Which is why whenever you are trying to react, especially on the retail level, you might be pretty late to the game. And you have to be very clear in terms of the rules of the game that you are trying to indulge in. So it's good to be kept abreast of world's developments, but don't convince or reinforce your own belief to the point where you cannot differentiate between a fact or an opinion. And just the rule of thumb for myself is that it's better to consume more opinions counter to your own belief system to keep yourself skeptical. And of course, do distinguish between things that you can control versus things that you cannot control. You can control your portfolio allocation, your sizing, your capital injection, your entry price, so on and so forth. And the last point from myself is that when listening to others in general, myself included, especially for those of you that are listening to this across the screen, I think this principle from the late Charlie Munger, show me the incentive and I'll show you the outcome, has been a game changer for my own personal life. So next time, whenever you engage in any sort of discussions or opinion sharing with people in the industry or outside the industry, just try to play this game called figure out the incentive. And I think you have a pretty good framework into understanding why they espouse certain opinions or give you certain perks or understanding of some sort of knowledge or information. And the last thing from me, I want to encourage you to kind of sit down to think about your mindset and relationship with risks and money. I've came to realize that many decisions that were made over the last 3 to 4 months, they were mostly made out of fear. And a lot of all these common questions that I received during this period actually revolves around the fear of losing money. Or on the other hand, the greed of wanting to make more money. That's why so many of these in and outs and missed opportunities or excessive risk-taking behaviors. So I do hope that you found this discussion useful and you took away a thing or two. And if you have any additional insights or sharings that you want to share through this period, feel free to leave in the comment section down below. And I'll see you in the next video. And more importantly, I'll see you on the moon. Goodbye.